Okay, let's talk taxes. With 2025 on the horizon, some big changes are in the air. We're going to cover everything from some pretty scary cautionary tales to brand new opportunities that could save you a ton of money. Getting a handle on this stuff now is really the key to not having a massive headache later. So, let's dive in. So picture this. You get into crypto trading, you make some smart moves, and bam, your account hits $1 million. You're feeling like a genius, right? But then the next year, you get a letter from the IRS with a tax bill for $500,000. And the worst part? By then, the market's crashed and your crypto account is nearly worthless. You don't have the money to pay. This isn't some made-up horror story. It's a situation a trader claimed happened to them online.
So, the big question, the really crucial question is, how on earth does that happen? How does a massive profit on paper turn into a real-life, devastating tax bill? Well, it all comes down to knowing the rules of the game before you start playing, especially when you're dealing with new stuff like crypto.
The answer to that $500,000 question lies in one fundamental rule that, honestly, a lot of people just don't know about. And it's this one little rule that can turn what feels like a simple trade into a huge taxable event.
And here it is. This is the absolute core of it. The IRS doesn't see Bitcoin or Ethereum like it sees US dollars. It sees them as property. Think of it like a stock, a piece of art, or a plot of land. So that means every single time you sell crypto, or trade one coin for another, or even use it to buy a cup of coffee, you're technically triggering a taxable event. If that crypto is worth more than when you got it, boom, that profit is taxable. That is exactly how that trader ended up with that massive bill.
Okay, enough of the scary crypto stuff, right? Let's switch gears and talk about some good news. There are always major tax proposals being floated around, and to see how new deductions could work, we're going to look at a pretty significant one that's gotten a lot of buzz, sometimes called the One Big Beautiful Bill Act. Now, it's not law yet, but it's a perfect example of the kinds of changes that could be coming for working Americans.
The first big number to get in your head is $25,000. This is a potential new tax break aimed squarely at people who work for tips. So the idea is this new no tax on tips deduction. It would let eligible workers, and that means both employees and self-employed folks, deduct up to $25,000 in tips they earn. Pretty huge, right? Now, there's always a catch. This benefit would start to fade away if you're single and make over $150,000 or $300,000 if you're married and filing together.
All right, next number to know, $12,500. And this one's for anyone out there putting in the extra hours and earning overtime. So how would this one work? Well, this proposed no tax on overtime rule would let you write off the premium part of your overtime. You know, when you get time and a half. It's that extra half that would become deductible. The max you could write off is $12,500 or double that for joint filers. And yeah, it's got the same income phase out as the tip deduction.
Great. So we've covered some potential new breaks on the money you earn at your job. Now let's pivot to making smarter moves with your investments and savings. And to kick things off, we're going to circle right back to crypto. This is so important to get right. Not all crypto income is taxed the same. You've got two different buckets. In one bucket, you have capital gains. This happens when you treat crypto like an investment, selling it for a profit or trading one coin for another. But in the other bucket, you've got regular income. This is when you get paid in crypto, like for your salary or from mining. You have to know which bucket you're in. So what can you actually do to manage all this? Well, you've got a few really smart moves. First, if you can, hold your crypto for more than a year before you sell. That way, any profit is taxed at the much lower long-term capital gains rate. Second, you can use something called tax loss harvesting. Basically, if some of your investments are down, you can sell them at a loss to cancel out your gains. And finally, for 2025, you can gift up to $19,000 of crypto to someone else without you having to pay any tax on it.
Now, moving beyond crypto, let's talk about a super powerful savings tool that way too many people sleep on, the Health Savings Account, or HSA. Unlike an FSA, which is that use it or lose it account that your employer owns, an HSA is all yours. The money rolls over every single year, and here's the best part. You can actually invest the money inside your HSA, letting it grow tax-free for medical expenses down the road. It's like a spending account, a savings account, and an investment account all rolled into one. It's a powerhouse.
And speaking of investing, one of the most powerful tax strategies available to pretty much everyone is using retirement accounts. Let's look at how you can really maximize these things for 2025.
The first step is really simple. Put in as much as you possibly can. Now these limits change a bit, but for 2024, you could put $7,000 into an IRA and a whopping $23,000 into a 401k. And if you're 50 or older, you get to add even more. For all you self-employed people out there, the limits for SEP IRAs and solo 401ks are just massive. You can sock away a huge chunk of your income and get a major tax break.
This brings up a really interesting strategic question. Does it ever make sense to voluntarily pay taxes on your retirement money today just so you can avoid them way down the road? For some people, the answer is a huge resounding yes.
It really all boils down to the difference between a traditional IRA and a Roth IRA. Think of it like this. With a traditional IRA, you get your tax break now, but you pay the tax man when you pull the money out in retirement. With a Roth, it's the opposite. You pay the tax upfront on your contributions, but then your growth and your withdrawals in retirement are 100% tax-free. And that's where this really cool strategy called a Roth conversion comes into play.
A Roth conversion is just what it sounds like. You move money from your traditional IRA over to a Roth IRA, and you pay the income tax on that amount right now. So who should be thinking about this? Well, if you think you're going to be in a higher tax bracket when you retire, it's a brilliant move. Or maybe you had a down year for income, that's a perfect time to convert at a lower rate. It's also an incredible tool if you want to leave tax-free money to your kids, since Roth IRAs don't have those pesky required minimum distributions.
All right, let's wrap up by clearing the air on one of the most confusing topics in our post-pandemic world: the home office deduction.
This is the question that literally millions of remote workers are asking themselves. And the answer is probably not what most people think. It really depends on one simple thing. Are you a regular employee or are you self-employed?
And here is the clear, no-nonsense answer. If you are a W-2 employee, meaning you get a regular paycheck from a company, you generally cannot take the home office deduction. Sorry, that benefit went away for employees back in 2018. But if you are self-employed, a freelancer, a consultant, you own your own business, then yes, you absolutely can deduct your home office, as long as you use that space exclusively and regularly for your work.
For all you self-employed folks who do qualify, you've got two ways to figure it out. There's the easy way, called the simplified method. You just take $5 per square foot of your office space up to 300 square feet. Done. Then there's the more complex direct method. This involves calculating the exact percentage of your home you use for business and applying that to all your real expenses, like rent, utilities, insurance. It's more work for sure, but it can often get you a much bigger deduction.
Look, let's be real. The tax code is incredibly complicated. The point of all this isn't to turn you into a tax expert overnight. The goal is to arm you with enough knowledge so you can spot the big opportunities and the red flags in your own finances. It's about knowing the right questions to ask when you talk to a professional.
So from dodging those nasty crypto surprises to using powerful retirement strategies, you now have the key pieces of your 2025 tax game plan. The rules are always changing, they're always in motion, so the only real question left is, what's your next move going to be?